do you think about the dollar? Like, it's kind of a tricky one for me. The dollar is
Yeah,
interesting. Like, is it
yeah.
going to play global reserve again,
I don't know.
or are people bailing on the dollar? That it's interesting. You got euro making. I mean, these charts look
What's
strong.
going to take place though?
Yeah.
Don't tell me Bitcoin. Don't tell me it's like is the currency market at $5 trillion a day going to be replaced because the dollar's losing status? It's like the dollar is everywhere, and
Yeah.
it would to me it's the currency market. It would take 5 to 10 years, I think, to replace the dollar. Um,
Easily.
and so, I mean, I think that the way the dollar has behaved these last couple of months with this, especially this like March sell off into now, I still think the structure, you've got some strong 2 year structure here that goes back into this first wave down into like 2023. And then it's clearly this like 101 to 100 area has been a noisy level, but also a very firm level of support. So I wouldn't be surprised if, there's some drama getting priced in here. The dollar is going to bounce in some way. I mean, I'm actually looking at, okay, so if it's not the dollar as far as currency pairs behave, is it the yen? Do you
Mm.
trust that the yen is going to be like this safe haven? Everyone's flooding into the yen. It's straight risk off, but the yen is also not immune. I mean, right now the Swiss is like the better safe haven of all the currencies,
Mm.
and I kind of hate it because obviously I'm enjoying my carry trades and watching
Sure.
those
Sure.
things
Yeah.
make fresh lows. So, but we almost in a way had a bit of a kind of a flash crash type event. I mean, that was a 3 to 4 day extreme that I think in the, let's say, medium term, will find a way in the currency land to find some bottoms, make its way back up into a pocket. And my goal is to, this is my break even right here. So I build it back into this pocket. I make some money. I'm not trying to hold these things forever, you
Mm.
know, but this is such a disruptive move in the currency market where just like you see, that move balanced like 50 to 60% of it. This move here is probably going to pull back 50, 60, or all of it because historical lows, lots of structure in here. You look left, it's like there's tons of levels back to 5,600. I'm trying to get this back to 55 and make some money. I still have
Yeah.
yet to move my buy stops lower, but I'm probably going to. If I start spotting a bottom pattern here, I'm taking this chunk of buy stops, moving them all the way down. I'll lower my cost basis more. Here's my profit window, and I'll still make,
I've got
probably three, four
I've got a
thousand.
similar concept going on with CAD Swiss right now. Kind of a
Yep.
similar trade
Yep.
to Australia. Got a
Exactly.
commodity currency. I've got 2 positions on. But yeah, I mean, I think you get any sort of normalization. A lot of the currency market will do what currency markets tend to do, right? To
Yep.
go back and forth over the long term.
Yep.
So I've been accumulating CAD Swiss. Aussie Swiss is on the list too. I wouldn't mind picking up some of that. I think that you play for the rebound there overall. That's at least what I would be doing.
Yep.
And then on the dollar, I have a euro dollar position. I'm looking to scale out or take profits on that one if we get like 112. So I'm playing this, maybe another squeeze higher on the euro. But to your point, I mean, what's going to replace the dollar? I don't know that anything is for now. Like, what do you want? Do you want a world that's run by China? Are you kidding me? Like, is that what we want? I don't know what the alternative is. I mean, clearly an obvious pick for everyone is gold, right? Gold is always that, when in doubt, gold it out, if you will. But the euro maybe getting a little bit of relative strength in all of this. The British pound, I mean, UK struggling with severe stagflation. It's just one of those things. It's like you look at currencies, you look at this global situation. This is not, oh yeah, no, US is going to torch itself and everyone else is going to watch unscathed. No, it's the
Whole
same.
world's going down, man. If
We talked
if the
about
US
this.
goes down, it's taking the whole world with it, and that's
We
why I'm like, at some point that narrative has to change because the US obviously
Yes.
doesn't want to fail, and the whole world doesn't want to fail. So figure it the fudge out,
Yep, exactly. And again, you talked about this many times on the stream. I listened to you talk about this concept of if the rest of the world goes into a recession, the US will be dragged lower. And now we're seeing the other way around. If the US is gonna, light a torch and throw one at everybody and start a big trade war, it's all one system, right? Whether
Yep.
people want to like it or not, or the US wants to deglobalize or not, like this is a global system. The internet made everything connected. So where one part of the world is very hurting, it can hurt the others. Even our biggest rival, we are their biggest customers, right? China, like it's all connected. So I do think that the US dollar, could continue to have a little bit of a repricing event to the downside. We may still see some short-term downside for the dollar index, but there does become a point where currencies kick in, and again, they go like this over the long term for the most part. They chop around, and I think that the dollar at some extreme, you can't just say, oh yeah, no, the dollar is going to collapse to zero, and then just in the same breath think like, oh yeah, and no, the euro is going to replace it unscathed. No, the whole world would be on fire if the dollar index, if the dollar completely collapsed.
Yep, unless you talk to Michael Saylor.
Yeah,
he's got the answer.
Bitcoin.
Which, and I literally had that conversation with one of my best friends on Saturday, and I like that whole conversation of Bitcoin enthusiasts is like, but then there's Bitcoin. It's like, it's still connected. BlackRock, with trillions and trillions under management. BlackRock is still tied to Bitcoin, which is tied to the securitized nature of the entire financial markets. Bitcoin is not immune to the entire world struggling.
And and like one of the biggest holders of Bitcoin is the U.S. government through confiscation of Bitcoin.
Yeah.
Do you know that?
I didn't know that, because I thought that was the whole disappointment with like the world, or the fund that we were creating was like our strategic reserve in the U.S., but it was just confiscations and fraud or whatever.
We launched the Edge Finder 3 years ago in April of 2022. And now, years later, the tool has helped thousands of traders take their fundamental analysis and sentiment analysis to the next level. Traders can track things like the commitment of traders data, which shows institutional money flow, whether they're buying or selling certain assets like gold and currencies and indices. Additionally, we've made economic heat maps that allow traders to track easily the fundamental or economic data trends that we're seeing in markets right now. You can also track retail positioning and see what the market sentiment on your favorite assets are right now to look for some contrarian signals. And of course, it strings it all together with the top setups algorithm, showing traders the most convicted top ideas that the Edge Finder is producing now. The Edge Finder has helped traders go from beginner to pro in terms of the fundamentals, and has helped many traders go from unprofitable to finding the missing pieces in the name Edge Finder. So if you're not already using the Edge Finder, let me tell you about the biggest discount that we offer all year long, starting right now. The 3-year anniversary sale is going to be our biggest discount that we offer all year long, and it is now available to people who are watching right at this moment. Traders looking to get access to the Edge Finder can take advantage of this massive discount for a limited time using the link in the chat being dropped right now, or in the description of this live stream. If you've been thinking about getting a copy of the Edge Finder, do not miss this opportunity. It is the lowest price that we do all year long, and it's a one-time payment to get access to the tool. So don't miss it. Celebrate 3 years with us by getting yourself a copy of the Edge Finder at the super discounted prices. Thanks for watching. And now back to the show.
What did gold do? It sold initially for the margin grab that globally, big funds needed that initial grab of cash, and they took it from everything, including gold. But gold was back to the highs within a few weeks. It's almost like the first place I would think, this is my best guess, and part of the reason why I am long gold and would like to stay long gold, you had that initial crash, rallied back, because that was the first place people felt comfortable going back into. So with this trade war stuff, even if there's some positive headlines, my question would it be people say like, okay, well, we'll get back into some stuff, but maybe the first place they go to is gold. I don't know. That's my fire from the hip idea.
Sure. Well, I'll say this. If we have a similar play as COVID, look, if this gets hit, I'm buying gold. It's that simple. And what's funny is, like, as this is falling, everyone's going to be panicking like gold is crashing, and it's like you buy it and it's right back up to the highs. So I mean, it's one of those environments where we are seeing some very wacky price action, and I wouldn't be surprised. I don't know what the catalyst would be to cause it, and maybe it doesn't happen, but if there is, I mean, we're creeping up on, we've got to be close to 400 bars now, Nick, and that is a long ways on a daily time frame. So let me just measure real quick. And I'll do this. I'm going to set chart alarms. We're at 383 bars. I'm going to set a chart alarm, any activated chart alarm here at this 144. So just add an alert, close, add an alert on the 200, close. Because the first thing I'll do is when that hits, I'm going GC futures and I'm going GLD again. And I'll add to my position like I've been talking about now for months, but I'm not going to buy when we're sitting here on gold about 2% away, 3% away from all-time highs. And this is the crappy part. Like, just like in 2022, which is that was a controlled, orderly bear market. But if you go year to date here, all this shows me is that there's no real safe place to hide. And right now,
Hmm.
Nick, bonds aren't even offering safe haven either. We've had an 8% swing in TLT.
I have to ask you about that, Chris. I have my speculations, but I think China's offloading. I sent you that message this morning. I think
Yeah.
China might be tanking or just closing out. I mean, they already had been selling bonds, but we might have accelerated that trend with what clearly seems to be like the closest thing to not firing bullets and starting a war, right? There's a
Sure.
straight up trade war going on. And so if we have, Chinese assets, we'd probably want to sell those. And the Chinese vice versa would be like, get rid of the American assets. We can't, that's super dangerous territory for us. And then meanwhile, we got gold shooting up today. So it's almost like, to me, the writing's on the wall that Central Bank of China has already been buying gold. We might have just accelerated that trade.
Yeah, it's true. I mean, right now, I just want to put this in perspective, because right now it's like China's offloading, Japan's offloading. Maybe they are, but
Yep.
this is the reality. We still own like 85 to 87% of our debt. So the
That's true.
offloading, it sucks. I get it, but like, because we're watching, frenemies become enemies and allies possibly switch sides and alliances. Maybe like that's what I think this is the worst case scenario. Like if we're getting worst case scenario, it's like we are going to be what Jamie Dimon said yesterday, which is he had a great quote. It said, "America first is fine, but America alone is not." Paraphrasing, but it's like, I mean, that isolationism is not going to be good for the U.S. because we might find ourselves, like just yelling at the world and nobody's listening. And meanwhile, we're sitting here with like this ticking time bomb of debt that needs to be and you can argue for a lot of cases like something like this needed to happen. This is Ray Dalio's changing world order. This is the fiscal cliff, the fourth turning. Like all these things are out there. This is the fiat system really being stressed. And so, I mean, look, man, there's nibbles here for Bitcoin enthusiasts. There's nibbles here for Igor and gold bulls. There's people that like what bond king. I mean, like what's his name? Bill Gross.
Unlock?
But like PIMCO, Bill
Couple of
Gross, like he no longer works for PIMCO. Like
Mm.
bonds have not been easy, and they've been like garbage in the portfolio. Like bonds are not good. Bonds have been in a 3 to 4 year drawdown. The only time they were rescued was that late Q4 rally in 2023, coming back from like another bear market, and they ripped up like 17% to finish positive on the year. But they've been in a 4-year bear market. And
and bear market, Chris, is lenient. I mean, they've crashed. They've
absolutely
completely done destroyed.
Yeah. So I just want to show this because like U.S. still owns its debt. And, the scary part is, yes, if all of a sudden the U.S. loses world reserve status or gets to get like knocked to world number 2, then maybe this changes. But I don't know. And it's like, I hate that I'm even thinking like so doom and gloom, but it's like, look, man, if this market, I do believe this, the financial markets are too big to fail in a way. Like there could be some restructuring, there could be some massive reset, but in some way, shape, or form, financial markets are too big to fail. There's too much wealth for the entire world, and you can see based on the price action from Friday last week to what we're seeing right now, everything is red. The whole world is red. And if anyone cares about the financial markets globally, they're going to find ways to figure it out. And it's not easy. Like it could come with a lot more pain, but it certainly comes with a lot more uncertainty. And this is probably one of the more annoying times I've had in my career. Like 2022 was challenging, but it wasn't this annoying because it's like, holy crap, are we just going to like, what's next? We go 20% and it's like, what's next? 30, 40? Like we just go all in one straight line. It's like, I don't think the market does that, which is why I kept emphasizing maybe this little like April 17th expiration, you're dealing with one of the most bullish windows in the markets, like seasonality wise from April, May, June, July, historically very bullish. And if we can just survive this window to not do too much damage, and the market's priced in essentially what is kind of this, trade war worst case has kind of been priced in. Now the next shoe to drop, like I said, would be earnings compression, which then maybe later this year is going to be jobs and labor if we have like a big September, December dump in unemployment. But I don't think it happens all at once. And so, but it's not out of the cards, man. Like I don't know if 4,800 is the low in the S&P. I think that maybe it's closer to 45, maybe it's closer to 4,000. But I'm not going to sit here and trade that way right now. I just know that I've got hedges out to December and see what happens.
Dow Jones, NASDAQ, and S&P have been moving in lockstep. That's very rare.
And even equal weight is no better. Like, so there's just not like, look, there's not a lot of places to hide. This proves it right here. Somebody wants to tell me, oh, this is about rotation. It's like bullshit. It's about rotation. This is a crappy market and nothing's good. And the only way you're going to
Nothing,
hide
no
out is if you
hiding.
want things to hurt less, then hide out in consumer staples and stop worrying about it, because it'll be fine. But it's not going to necessarily be a bull market. It's just going to be preservation of capital. You want to hide out in utilities, it's fine. It's not going to go anywhere, but it's going to go down less because it's way less correlated and way lower beta. You want to hide out in healthcare. I mean, healthcare might have some surprisingly good price appreciation because
Well, you get some dividends.
Sure, all of them get dividends, but you pay
Mhm.
tax on dividends. But I'm saying, like, utilities aren't going to do anything price appreciation wise. Maybe they will, maybe they won't. But healthcare has an interesting mix because there is an AI element to healthcare. It's one of the fastest growing sectors in the world. It's like our baby boomers that need this care. I mean, the healthcare costs are just rising like crazy. The need for, well, for right now, the need for nurses, doctors, people in the field. My concern is over the next 5 or 10 years, AI starts doing more of this. Like, think about all your symptoms put into an AI machine, and it's basically the people cares, like HR, maybe like one HR person to run a department to handle
Yeah.
all these, like,
Another one, Chris, with that same line of thinking that I really like for the long term is medical device companies, Medtronic, Intuitive Surgical. I mean, some of these companies, like Intuitive Surgical, is very, very expensive stock. But yeah, no, what you're saying, the whole medical world is like ripe for AI to seriously level up humankind. I mean, that is some really practical stuff. Healthcare was a big favorite for me personally going into this year. Now, I got to disclaim, if I was really smart, I would have had most of my portfolio, and I did not. But I did have plenty of healthcare stocks going into this year, and continue to like that as a potential outperformer. So far, it's doing pretty well. But what you're pointing out here with this breadth thing here, right? Just basically everything moving together. I think it's reasonable. I've been talking about this, Chris, and I've heard you leaning more cautious here recently too. With this big kind of market downturn, it's also fair to acknowledge bounces can be very violent, right? I mean, we had just a massive turnaround in the last 2 days, and then of course down again. And then what you're pointing out there, everything kind of uniformly down. Does that give you like the theory that like, okay, probably looking a little oversold in the short run, maybe more pain ahead? Or do you think you ignore this trend this time? I feel like you kind of have to look at this thing and say, look, it's had a great track record, innocent until proven guilty.
I think so. I've been looking mostly on like the weeklies and monthlies because it's so rare to see them. But what I'm looking at probably on the daily is if I see a green close, I'm probably going to take a little bite. I'm willing to take a bite because, and all I need is like a 2 week to 4 week window, because that's usually about if we are in a bull rally in a bear market environment, then a 2 week rally or 2 week recovery could be surprisingly bullish. Like, and that's what catches everyone off guard is, I mean, if we clear this high here, Nick, if we clear 5260 here on the SPX, we could rip all the way up here to 5400. We could rip all the way up here into 5600. And it's going to catch everyone's, like, it's going to rip everyone's face off with how aggressive that is. And then the bears are going to be like, hey, that was cute. Now we're going to go right back down.
I was going to say, in 2022, look at what you had. You had some of these, maybe we can share my screen here for a second, guys. We had just a violent down move, up move, down move, up move.
Double-digit swings the whole way for 2020.
And this move, that's 24%. Doesn't look like that, but it's 24% move up. Right. And then this move was, 17, 16%. So I think that it's really important that I've just been seeing people who are now thinking, Chris, that the easy money is just being short. And I think that's such a dangerous mentality because shorting is inevitably, in my opinion, one of the hardest trades to get right on the indices because it's so short-lived, so sharp. And you can take profits way too soon. It's just very, very difficult to the windows are so narrow, but the profits are so big if you're right.
Yeah. I mean, and that's why, like, the way that I hedge is it's a cost of doing business. It helps me protect the portfolio. I have to do it in increments. I mean, this was definitely more of like a strategic hedge because I was pretty bearish going into the start of the year, like at least expecting a correction. So we got it, and we had more than that, obviously, with this flush down. But getting bearish at a 65 VIX is insane to me because everything is so expensive to do so. I mean, I'm very lucky that the hedges that I put in place are after this flush and this retracement. I put in hedges that are essentially the rest of the year. I'm like, no funny business here. If we're dealing with a bunch of nonsense and we don't get back to these highs again, I want to make sure these hedges are in place. So, I mean, I'm sitting at a good chunk of profit. If it gets worse, if we stay down here, we just keep like troughing these lows and keep hitting these levels over and over again, or like the bottom falls out again. And I said this on this chart, dude, this is not a good spot. Like technically, this would be a very scary area for the overall market, because if we break this spot, this level is wide freaking open to reset all the way back into the lows of 2023 and maybe even back down to the lows towards 2022. And that, I mean, that is probably the worst case scenario in my opinion. Is like we wouldn't go too much lower than like 3,000, but you talk about a percentage. I mean, we're already talking like historical type movements of how fast we got to 22%. But on top of that, you go 51% down. I mean, that is a full-on economic reset, and what almost feels like could have been avoided. Maybe it could have been handled differently. So I think that's what's so frustrating about this. Is like, does it have to play out this way? And some people argue, yep, it had to. The U.S. was heading towards the fiscal cliff. It's got to happen. But I don't know. I mean, I guess because we do this all day, every day, it's like, I don't think it had to play out this way. It could have been a little bit more uniform, but nope. I guess it's it's not just a band-aid. It's sever the arm and sever the leg, and maybe you're limping in with no limbs at all. But it's like, if that's what it is, guess what? There's going to be buying opportunities, Nick. At some point, if we get this level to go up or we get this level to go up, then there's wealth and wealth and wealth to be made.
Well,
but
and Chris,
again, you don't survive that, you don't trade.
If 3 years from now the market has stabilized, now of course 3 years from now the market could be lower from that. I'm not saying it's a certainty, but if 3 years from now we get some normalization out there, we get some resolutions, we get some compromises, we get some better than expected, better than worst case scenarios, right? If that starts to play out over time, not saying immediately, Trump might have to get out of his system for a while, I don't know, but if eventually we find ways to move past this and move forward, the thing is, nobody's going to ask you if your account, I mean, of course, for most people, nobody's looking at their account, but for you and I, Chris, we're in the public eye, right? People are watching what we're doing. Yeah. So, we can make, I've gotten slammed for being wrong on this might be a bottom and all this, but at the end of the day, if I'm accumulating shares slowly without leverage, in 3 years, if the market's up here, nobody's going to ask if I caught the bottom or not. They're just going to ask, how'd you do overall? And I think that your risk to reward gets better as stocks go down, whether people like it or not. There's so many people out there calling for a way bigger crash, but to your credit, if you're bearish, that's how professionals play it. They wait for these moves. They're not shorting here saying, yeah, this is it, time's up, game over, stocks to zero. That is hype and gambling and foolishness to the highest degree in financial markets. You have to be really careful not to chase, even if you're bearish. Again, I think that there's way better. You asked me about this the other day. Isn't that a way better looking risk to reward? Absolutely. If you're bearish, you have good reason to be. Your strategy says so. The risk to reward, in my opinion, is way better here, because what's going to come with this? Put to call ratio is going to look a lot cleaner. VIX is going to look a lot cleaner. You're not going to be paying an arm and a leg to buy puts. When I see studies of people saying like, oh, just lump sum invest, it's so much better. Well, yes, in an environment for the last 20 years for the NASDAQ and the S&P 500, which have gone pretty much straight up for a number of years, nothing's going to beat lump sum investing. But if you ask somebody in Japan who's 60 years old right now, they might have a very different answer and say, look, I used my income and just bought in at lower prices on great companies and actually ended up doing okay, rebounded my portfolio way sooner had I just put it all in right before the big crash, right? So just
lump sum at all-time highs, that'd feel really good, right?
Yeah, exactly.
Yeah.
That would be
and I was going to say, and dollar cost averaging too is an index play rather than a stock play. Yeah. I never love dollar cost averaging into stocks unless you firmly believe that stock is in a moat, has this huge advantage. But the crazy statistics is over the last like 30, 40 years, if you dollar cost average into stocks, the performance is usually terrible. Like somehow the stock pickers of the world, if you don't get it with like the right run, it comes back and resets. A good example would be Meta, because Meta for almost a decade returned nothing. Because we had, I mean, even looking at it now, it's like you go back to Meta here when it was let's say from 2017. Okay, it's just a silly example here, but from 2017, you had a 200% return on Meta, and then in 2022, you lost everything. So, I mean, if you're going to dollar cost average, sure, but after 4 years of holding a stock, you're back to zero and possibly negative because of your dollar cost average. You're adding to higher highs,
Yeah.
and you lose all of it. So you're sitting in a huge position in the downturn, and then you get this, and again, I can see the argument being made like, well, it's still, but dude, I don't want to hold anything for 4 years and be flat or negative. So an index to me is like, you can participate from Meta being great. You can participate from Palantir being great. Participate with whatever stock is going to be the greatest thing ever this year, if there's anything. Participate in an index that catches that move. And I know it's a fraction of what the performance is. Like Palantir last year was what, 300+%? Best performing stock in the S&P. But it also comes with a 40, 50, 60, 70% drawdown. And it's like the index, it's like, dude, we're down 21%. And it feels like the worst case scenario. And it's not, but 21% is manageable compared to a stock that's down 70%, 80%, 90%. Because to me, and I have a lot of traders that do this. Somebody told me like just last week, like, hey, Chris, what about NIO? Chinese EV play at $3. I'm like, okay, man, at some point this stock was from basically $2 to $64 seemed like the greatest thing ever. Look at it now. This to me is dead capital. I don't care if I had 100 of these stocks. If 99% of them didn't pay out, that one that may be a winner could maybe get you to break even if you're lucky. But it's like, that's not, I don't want to lose 99 trades to make one winner. And that's just
NIO is a great example, Chris, because I remember, the hype around this. Oh, this is the Chinese competitor to Tesla, and it's going to take over, and it's. That's the thing is and here's another one is Cisco, right? That's the classic example of here was many of us, myself included, were not trading at the time that this was the hype machine that it was back in 2000. But I mean, guys, this was the Nvidia of the time. Like, understand, like this was the unbeatable, undisputable, moated and goated king in the stock market, right? And what happened? Well, it crashed and gave back all of its gains and took, many, many years. I don't even know. Yeah, I mean, it got back. I mean, it's still at the same point right now as it was 9,000 days.
It took over a decade to get any traction to even start coming off of those lows from 01. A decade. And not only that, but a decade that you lost 80% of your money.
Well, and the average person that was buying this, Chris, the average person that was buying this was definitely not dollar cost averaging on the way down, right? They were getting either destroyed completely, lost all their money. Like that person was not as practical as people who, maybe who have bought Cisco after the fact and maybe have done well with it, but
maybe.
It's just you have to be so careful in these markets. There's winners and there's losers. And, what I found is your risk reward just gets a lot more attractive when you wait patiently for opportunities to come to you.
Agree. And, look, if it was easy, everybody would do it. And if it was easy, everyone would be a Stanley Druckenmiller, a Jim Simons, Bill Ackman, Warren Buffett. Like, they're not. Nobody is, right? It's like, and honestly, if a good book to read for anybody would be Market Wizards. You will see that there's a common thread with all of those people that are in that book from Jack Schwager. They all have like a very fortunate window that if they're humble enough, they'll acknowledge it, but their fortune was made in a very brave call that set them up for their entire legacy. Like Stanley Druckenmiller that ended up working with George Soros, like he put like 70% of his entire portfolio in oil in one. And he was a genius, and he did this for like 3 or 4 times over a decade, and it was like all in like 70-30, 80-20, and he was right. But I was like, all it took, again, I'm not like faulting the guy. It's like Stanley Druckenmiller is amazing, but if he was wrong, you would never hear of him.
The thing I've been looking at the most has just been staying true to the put to call. Look at this thing. But again, to your point, I thought the put to call ratio was high over here, and then boom, it just really took off, So crazy.
Okay. Yeah, that's one kind of the charts I'll be looking for. I'm going to try to find like if I can see that institutional levels are coming back in, like as far as like, and I can follow money flow. That's one indicator I can always use. I think it's CMF on TradingView. But if I go CMF and I'm seeing that institutions are, elevated while the retail crowd is dumping, that to me is showing that like real smart money, real big money is actually willing to step back in. That crossover to me is a pretty good sign that, real money's come back into the market for a sustainable investment, as opposed to like short-term, net swings. And retail traders are typically always over leveraged, and they're going to get beat up the worst.
Here's one that I found really interesting, Chris. This is the historical data for the Japanese yen. Look at the yellow. The yellow is showing you the long percentage overall for contracts traded on the Japanese yen, institutional money. Look at how steadily before all this took place, there was just a buildup in bullishness for the Japanese yen. I find that just so interesting. We also saw that back in August, right as that kind of big yen strength came into the picture. Institutional money was building up, and then they deleveraged on that yen, and then now getting back into Japanese yen for the last few months, and which has been a great play here recently. You mentioned FXY, you're playing that. I mean, yen's been very strong recently.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button, or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.